Thank you for joining us. My name is Russell Ballou, and if you've come for the Elegant Exits webinar, you're in the right spot. And if you want to learn about how to make the most of one of the most monumental and important decisions you will make as an entrepreneur, as a business owner, that is the elegant exit that transitions you into magnificent means, you're in the right room. Transitioning out of a business that you have built with dedication and hard work over many years is an extraordinary decision. Whether you're planning an exit, succession, merger, or sale, the process is overwhelming without the right preparation and guidance. Today, we want to demystify and de-stress this important crossroads in the lives of every business owner. And we've assembled a team of very experienced practitioners. It is my privilege to introduce this team and to ask some questions to help bring out some of their tips, tricks, and insights from many years of helping entrepreneurs, business owners make the exit that makes their life change. And so without further ado, I will start by introducing myself. My name is Russell. I'm a private wealth advisor at Raymond James. And what we do is we help our clients make the most of all the world has to offer, all the world has to offer in both the public and private markets to advance their interests and protect the cherished fruits of their very hard work. I'm joined today by three professionals. The first, I'm very pleased to introduce as my friend. She's in Hawaii, and she is living that life we all aspire to once we make that elegant exit. Natalie! Natalie is a certified exit planning advisor, which means that she is properly credentialed and deeply experienced in the high arts of bringing together the three legs of the stool that make it possible for you to transition. And we'll talk to her in more detail soon. Thank you for being here, Natalie. Next, my very good friend, a graduate of Harvard. Couldn't resist that, Jack. It's quite the brilliant human being that's been doing this both at the corporate level on some of the most magnificent, large transactions to the smaller stuff that we know when we were dealing with small businesses. Jack has leveraged his Harvard degree in multiple spaces with all kinds of deals. Frankly, there isn't a tip or a trick that the other side, because when you bring the lawyer in, sometimes it can be adversarial, and we'll talk about that. There isn't anything that that counterparty might show or do that Jack hasn't seen before, and you want that kind of person on your side. Finally, representing tax. That's one of the big things we're always concerned about. We got to find the deal. Natalie helps us with that. We got to negotiate the deal. Jack gets that done. And then finally, once we have all these means, once we've collected our money, sorry for being gauche, we want to make sure that we get to keep as much of that as possible. And we're looking at that today from the perspective of the Mandel family office. Josh is going to be representing that office. Thank you, Josh, for being here. Another dear friend.
My pleasure.
I think we have all the coasts, all the way from Hawaii to New York covered. So let's get into it. We'll start with you, Natalie. If we could highlight Natalie. What I want to do is to just really talk about this process. You know, at Raymond James, we take great pride in planning. And so what I want to ask you is, when should the planning process for an elegant exit begin, please?
Well, the best answer for something like that is really when the business becomes real. The moment it starts to matter in someone's life, in the owner and founder's life, it's part of your family, it's part of who you are, it's part of your identity. It's important to note that planning for an exit planning is not an event, it's a way of thinking. So that every decision a founder makes, even from the beginning of how revenue is structured, how dependent the business is on them, how the team operates, how customers are retained, they're building a future of freedom, or basically they're quietly walking away from it. So what's really good to note is that most owners think that they need to feel ready to exit, but really you want the option. You want the optionality. You want to be able to plan because you don't want to be in a position of urgency or necessity that you have to sell, because then you're not necessarily in control of your options. And that's why you want to work, and the work that I do specifically, I work with owners years and years before a transaction's actually on the table. Does that help, Russell?
A lot. You said the word option. Uh,
Mhm.
when I think of my work as a financial planner and a wealth manager, I love buying, that is, purchasing the option for something well in advance. And so, what I hear you saying is that, and it goes back to the maxim in the certified exit planning advisor training, and that is exit planning is actually strategy, it's business planning. Is that correct? Yes.
Absolutely. It should be
Oh,
considered right when you're thinking of your strategy. It doesn't have to be a decision at that time. But again, you want the option because you don't know what the future will bring, but you don't want to be in a corner doing it last minute or under any level of duress, nor have it planned so it's not functioning the way that it needs to be.
well, this brings me to the second question. I also heard you use the word walk away. A lot of times, business owners are so thoroughly enmeshed in their business that the business can't run without them or they can't see themselves without the business. How do you get people to break through that? And if you can help us understand how that actually breaking through and having the business be less dependent on the owner actually makes that business much more valuable.
Sure. That's one of the key items there. Um, as far as the business being dependent on the owner, when depending on the size of the business and the plan of it, in the beginning, many times the owners are always involved. However, in building a team and in growing the business, one of the keys for a great exit as well is you never want the business to be dependent on the owner because that will also play a key role in the valuation. Oh, I'm sorry, we have an alarm going off. I'm traveling. Um, one of
May I
the
have your attention, please?
Russell, why don't you go to someone else while this is going on? I apologize.
Yeah, I hope you're
There
safe.
has been a
Absolutely.
It'll
We
be
can do
okay.
that. We'll come back to you.
fire.
Uh, okay. So if you could spotlight me, please. One of the points that Natalie was bringing home is this whole idea of, hey, if I'm going to buy this business and the owner leaves, what am I left with? This is a critical component of what needs to be considered. And I think that things have settled down near you, Natalie. Should we continue with you? Oh, you're still waiting. Okay. So what we'll do is, because we do have a team, and that's how it is. When one person needs to pass the ball, we'll get it over to Jack. So if we could spotlight Jack, and we'll come back to Natalie. Okay. Jack, are you ready to go here?
Sure, I am.
Wonderful. There's the spotlight. Thank you. So let's go ahead and ask your question, Jack. Okay, so here's the thing. Once Natalie, or a professional like Natalie, there are very few like her, has found a willing partner with which to transact, that is to purchase the business, we get into the hard parts. And for many people, there are some who like to haggle, but most don't like that at all. That's your thing. So here's the question I have for you. When does the process of negotiating between the buyer and the seller begin? How do we prepare for that, please?
Most transactions fall, have a two stages. And tick-tock negotiation theory is the view that um, the first phase, or tick as it's called, is characterized by low urgency, information exchanges, and positioning. That's the time period where people are signing NDAs, they're conducting due diligence, they're exchanging information, beginning to frame out, what the term sheet is going to look like. When you get into the actual substantive negotiation, of the definitive transaction documents, that's where the talk comes in. The talk is typically got much more deadline compression. Uh, there can be accelerated concessions on either party, and sometimes forced decision making as you work towards whatever your deadline is for negotiating the transaction or not. So it's really a two-part process, but with a lot of subparts.
Thank you. Staying with theory, we just learned a new term today, tick-tock theory. And you said, hey, it begins with sharing information. There's another one that's called the best alternative to a negotiated agreement. Can you tell us what that is and where does that kick in, please?
Sure. The best alternative to a negotiated agreement, or sometimes it's called a BATNA.
BATNA,
Um,
yes.
yeah, that's when, the parties determine what their most attractive alternative is if the deal doesn't close or move forward. It really scopes out the walkaway position against which any negotiated outcome needs to be measured against. And ultimately, it can have a significant impact on who has leverage at the table. One party may be committed, at all costs, the other less so. And it can vary depending on whether you're the buyer or the seller. In an M&A context, for sellers, the alternative is often, or the BATN is often continuing to operate independently. Or instead of selling the whole company, considering a minority investment or recapitalization, or, potentially looking at a dual track IPO as an alternative to a sale to a single buyer. Or just taking the company off the table altogether for a period. For buyers, it often looks like having an alternative acquisition target. What other competitors are there in the industry that, the focus could shift to? Or as an alternative to another acquisition target, it could be organic growth or a build strategy instead of a buy strategy. Could also include things like a strategic partnership or a joint venture or capital redeployment. So, these are things that both buyer and seller, should be thinking about and considering, prior to in engaging. And, why does it matter in a transaction? Well, the BATNA helps you anchor things like pricing discipline. It can help to sharpen decision making, and it can also prevent value erosion late in the process by, giving up concessions that you did not intend to give up that, could undercut the value that you had negotiated for at the beginning.
Jack,
And
this ability to come up with a robust BATNA, the person that has done that has great leverage. Can you give some examples of how your expertise, Harvard trained lawyer, many years of experience in a variety of settings, how you've helped your clients really make a robust BATNA, please?
well, if you apply it to the tick and the tock phases, that we were talking about, um, in the tick phase, what it often looks like is preserving and enhancing, the credibility of your alternatives. It can involve, running a parallel process, advancing standalone plans, or, avoiding a, premature entry into an exclusivity with one buyer or another. In the talk phase, BATNA becomes more operational rather than theoretical. Um, Parties with superior alternatives can stand firm on price, can retrade risk allocations in terms of things like reps and warranties, covenants, which are really allocations of risk post closing, or they can credibly walk. Um, so if there's a party, for example, that's, has a, facing a financing, in a situation that is, less than locked down or some board mandated deadlines, those parties are often in a weaker position and might find themselves in a position of caving first, and they would have, less leverage. Ultimately, BATNA defines whether a party can walk away. TikTok dynamics determine when walking away becomes optional or optimal, I should say. Together, they give you a framework for negotiating price, structure, and risk allocation.
I think that we just learned a lot. I feel like I want to go take a law degree. Not. I'm going to call you. Uh, Natalie, are you in a good spot? Okay. Jack, I'm
Yes,
going to
we
come
cleared
back
the
to
alarm.
you.
Yeah.
Okay.
Sure.
Thank you very much, Jack. We just learned about TikTok theory and BATNA, and he helps folks gain maximum leverage. I'm coming back to you, Natalie. We now know
Sure.
that we have a competent lawyer to help us get the deal done. I want to ask you, and this was the question we missed just now. First of all, I'm assuming everything's safe over there. I should have asked that first.
Yes, I think they were testing the fire alarms here, but it's all cleared now. Thank you, though.
Okay. What would you say are the top things that you look for when you're finding a worthy buyer for a business seller?
When we're looking for a worthy buyer, well, first of all, it will depend on the business. Some businesses can actually work better with an individual buyer. However, many and the area that I tend to focus in the most are strategic buyers. And the reason that we work more with strategic buyers and we position the sellers for that, and that takes some time and work, and that's why you always want to do these things in advance, and very early on, because you forget to do it and you don't want to be in a rush at the end. Working with more strategic buyers, we're also able to get a lot more value for our sellers. Um, if they have a goal of maybe maintaining legacy or maintaining a name, having someone else carry it forward, or the idea of what they have built, have someone take that forward. A lot of times that isn't a strategic buyer that will work that. We've worked with buyers such as Nestle with very small businesses that might have been white labeled, but ultimately they were the best buyer. But it also, interestingly enough, when you work with a strategic buy, it increases the multiples quite a bit. And people focus in on that and they say, oh, no, no, this multiple is only this, the buyer's only going to look at that. What's really about positioning as well, because the work that we will do is we take it out to what it can be and what it can be in their backyard, if you will, from a strategic buying standpoint, which is much bigger if you present the vision. And it is almost a going to market in a different sense of what it would look like under their umbrella. So,
Sure. And let's break that down because
mhm,
many people listening may not know the term strategic. It's really an acquirer that sees that
correct.
business as fitting into their existing enterprise. And
Thank you.
when they
Yeah,
bring that business in, it allows them to drive mechanics either in that business or in their own that are multiples of what that person by themselves might be able to do. Is that a fair way of defining strategic?
absolutely. Yeah. Thank you for clarifying that. Sometimes I get stuck in my world and I assume people know the same terminology. So I appreciate that. Yeah.
Okay, that's huge. And for the last question, Natalie,
Mhm.
it's simply this. You have a magnificent education, a pedigree that has allowed you to live on the island. I mean, you're the only one in this gathering here that doesn't have a suit on, and there's a reason. You've earned that. What do you bring to the
Mhm.
party, please, Natalie, that when we refer our clients to you, they can rely on to help them make the most of their elegant exit, please?
I guess I could just answer that with a few things. One, I had a previous business in the late 90s, early 2000s that I sold for a few $1 million. I had a partner and we exited. Nice exit. So I've been on that side. Then I went to work for HP and I went to work for Pearson and I ran very large deals from the buyer side as well. So I
From the
took
side
the
of the strategic, a corporate
exactly.
strategic. Yeah.
And also some of the smaller ones, but I wanted to take those playbooks that I learned and also being on the side of selling. And in a previous life, I worked for Ernst and Young, so which was Arthur Young at that time, and Ernst and Winnie took over, and that was a hostile acquisition. That was not an easy one, and I was on the Arthur Young side of being acquired. So I have been on both sides of it and seen it both from a large side, from a smaller side, seeing the strategic work and seeing individual buyers, but taking some of those playbooks and bringing them down to what I would call the real world of making things work. Um, I think that's what I bring that to the table, but I also, in working with exits, I won't work with anyone that does not want to talk to me about what they're going to do next, what that transition is going to look like, how we work through it, and the emotions, and I get to know them, whether they want to get to know me or not. This is how we're going to work, because I don't want them to call me in a year and say, "Why did you let me do this?" I want it to be successful for them. I want it to be successful for the entire team, for example, that's on this call that we're working on together, because this type of team and the skill set is very important for a successful deal. But
Yeah,
there's so
Natalie,
many
let's just
different
highlight
layers.
something because most of these don't fit, or the regret doesn't come from getting the multiples and the rest of it, because we all know our work. It's often that the business owner is like, well, what do I do with myself now?
That's
And you
usually it. Yeah.
actually conscientiously surface that early in the process. Is that right, Natalie?
I, I do. I even make them write a letter of goodbye to their business and keep some letters going forward as to what they're going to do. And some of the sellers that I've worked with, we're in touch as to, okay, well, what's on your agenda today? So yeah, that's really important. You focus on more than one thing. So you coach it, it's a way different level of advising. It's really being in touch with who that person is. And everyone's different. That's one thing to note. It's not a one size fits all. So you have to work with everyone and acclimate to how they understand things.
Natalie, we're grateful to have you here. Thank you. We'll come back at the end,
Sure.
unless there's anything else you want to convey now.
No, thank you very much.
Okay. Jack, we're going to come back to you. And thank you for
Okay.
stepping in before. If we could highlight Jack.
Do I need to? There you go.
All right, here we go. So, Jack, here's the thing. Natalie talked about her experience and having worked in both hostile and more amicable deals. Let's say I have a situation where I know I have a strategic and they're the best potential buyer of my business. They are, but they're hardballing me. How can you help me with that situation?
Well, just to make sure I understand the question, the is the target is a unique strategic opportunity for the buyer, or is that the question? Is that
Sure. Let's say that so I have a great potential buyer for my business. And
okay?
I've worked with Natalie and yourself, and anyone in the world will say, Russell, this is the right buyer for you. But I'm not necessarily happy with all of the terms. How do you help me come to peace?
Well, it's always helpful if you can run a parallel process and have another interested party, that is, willing to, willing to come closer to the terms that you're looking for. From a seller's standpoint, um, I don't know if there is one perfect buyer. The most perfect buyer is one that is the one that will help you achieve a certain economic outcome, and without exposing you or forcing too many risk allocations post closing on you. Um, from a buyer's standpoint, there are unique strategic assets that can be absolutely critical. When I was chief legal officer at Public Storage, when I joined the company, told me they had been chasing their biggest competitor for 20 years, trying to get them to the table. And I was tasked with the responsibility of finding a way to, bring home what for them was a sort of a Moby Dick type target. And it was a unique strategic target called SureGuard Self Storage. We went about that by initially, starting up. We made an offer, it was rejected, and we went hostile. I've, like Natalie, worked on both friendly and hostile deals. That was an instance where it started hostile, where we went directly to the shareholders. And it ended up friendly because the shares of the company, very little were held by management. And they moved rapidly into hedge funds and what have you. And that gave us the opportunity to acquire that unique strategic asset. So I hope I'm answering
What
your
I hear you
question.
saying in answer to my question is, Russell, we will find the right way to make this, to bring it home. And sometimes
Mhm.
we have to shift the nature of the offer, the terms, or the actual end buyers. I like that. Jack,
You
if
have
you
to be
could
willing to be. No, sorry, go ahead.
please finish. We want to hear from you.
No, no. It was just going to suggest that flexibility is very helpful, and having the experience of working on many transactions gives you, different tools in your toolkit to try to help get there.
Which brings me to my last question, and that is, why would we want to work with you and Cogent Law?
Well, attorneys who practice mergers and acquisitions, good training and negotiating skills are table stakes for any M&A lawyer. They're all skilled, whether they went to, the schools I went to or anywhere else. I think that two things that set Cogent and myself apart are the experience I bring to the table of having worked on hundreds of transactions over the last several decades, as well as the value that's delivered through a firm like Cogent due to the fact that the attorneys at Cogent all operate remotely. We
Yes,
don't
right.
all come into a glass office tower, and we don't have that expensive overhead that most law firms are required to pass along to the clients. As a result, what we offer is big law trained attorneys like myself, who started at, uh, first, began working in M&A when I was 17 years old, the summer before I started college, working at Wachtell Lipton in New York. And later, after I graduated law school at Skadden Arps, New York, two of the biggest M&A firms on the planet. So you get that level of experience, but as well as the things that followed, and being chief legal officer of private companies, or rather public companies like Public Storage and um, company in nuclear medicine. But you get it at a price that is far more attractive than you would get at if you were hiring one of those firms. An M&A lawyer at one of those firms might charge 2,000 an hour and up, or 1,500 an hour and up. Our prices are about half of the lower end of that spectrum, maybe 750 to 800. So you get experience combined with value at a firm like Cogent, which can be very attractive um, to many clients.
Absolutely. I mean, this idea of value, I'm so happy that you surfaced it, because when we think about Cogent Law, from John, your founder, on through to all of his illustrious associates, all of you are extremely experienced, and a person can get you at a very affordable price. But they aren't getting cheap, they're getting skilled, again, at a good value. Thank you very much. Let's go to, is there anything else that you want to convey that I may have missed, please, John?
Not at this time. Thank
Okay,
you.
we covered theory, and we covered your practice, and we covered cost. We'll pivot back at the end for final remarks, but let's go now to tax, if we could, please. If we could highlight Josh.
All right.
Okay, before we start, Josh, everything that we're doing today is a bunch of friends in a room sharing, and we are trying our best given our experience and background, but none of this should be construed as professional advice. Not in the
Yeah.
remotest sense. It's just us sharing our thoughts and best
Great.
practices from many years of experience. You're in a unique position because you actually represent the Mandel family office. And in that capacity, you have actually, let's call it, you're on the other side of the asset picture, right? You've done your exit, you have your means, and now you're looking at, okay, how do we make the most of it in a tax efficient way, both for ourselves and our fellow family office friends, associates, and clients? Please, Josh, I have a question for you, and that is, for a person that wants to cross the chasm, they want to get to where you are, open their family office after their exit. When should they start thinking about tax?
Now, Actually, I would say yesterday. I know you were ready for that one. I mean, really, if you're thinking about how do you want to build your wealth, how you plan for that, you should start thinking about tax mitigation years before any sale is on in the picture. Years. I mean, ideally, it's years before you're building any amount of enterprise value. I mean, this is not, taxes, I think, aren't something that you would try and achieve or solve at the closing of the sale, right? Right. This is a result of decisions made over a long time with a team around you, thinking about ownership, your entity structure, how you're structuring your income, how you're qualifying your assets, where you're placing them. I mean, once there's a buyer or I say letter of intent for your company, you're mostly like revealing what the tax bill is. You're not controlling it at that point. So, in my experience, the founders that we work with, those who do the best are the ones who are thinking about exit planning and tax planning as part of the same process, not separate events. And there are a lot of ways to approach that. We talk a lot about
Well,
event.
let's just highlight that because it's a big point. Hey, listen, just as Natalie said earlier, exit planning is business strategy planning. It's actually what we do day to day to build in value, to separate the owner, make
Mhm.
processes that are repeatable, scalable, valuable. Well, the tax thing is the same thing. We're going to be thinking about taxes day to day, as you said yesterday, and throughout all parts of the process of running the enterprise. Is that right, Josh?
100%. It's got to be part of the planning from day one. Even though you're not thinking about it, you need to plan for that eventual result. I mean, some people, they want to own their business, they think this is going to be my life forever, but that might change, and that will change. Very few hold the business from an early part of their life through the end. And for those that do, great. And they make it, they can pass it off to the next generation. But even that, even if you're looking to build and just hold on to it for yourself, there has to be thought that goes to how you would pass that to the next generation. So there are many approaches to doing just that.
Well, let's get into some specifics. I know that you're pretty passionate about finding ways to mitigate taxes.
Yeah,
Um, why don't you take us through one of your favorite approaches to helping business owners with their taxes yesterday?
absolutely, absolutely. And I will say, as you said before, like I'm not a tax expert or advisor. Maybe an expert now, but I'm not giving tax advice here. I'm not an accountant. I'm managing part of a family office, a multifamily office that helps our clients think about things in a creative way. And there are some really powerful tools available to people and companies that many don't know about or have not been exposed to. For many folks, they work with accountants who simply are reporting what happened, not thinking, what can we do to make this better for you next year or this year? So I'll give an example of one strategy that we've been working with for probably over 30 years now, and we advised a billionaire family, a real estate family in New York, many, many years ago. Is something called private placement life insurance, where it's basically using insurance policy to take ownership of investments. Now, there are restrictions around your ability to manage those funds. There's separately managed accounts, or you can have specific IDFs. So there are funds that are focused just on these types of policies. But what
Sorry, IDF for the audience, please.
it's these are insurance dedicated funds. These are
Thank
there's
you.
a, there are a few
IDF.
different there are a few different approaches to how one would structure PPLI, and we work with our clients to figure out what's right for them based on whether that's international or US or a mixture of both. But the key, what you're trying to accomplish would be you're reducing or eliminating capital gains completely. You're creating a tax-free compounding vehicle. And in some cases, you're able to use some of these insurance tools to help buyers, sellers bridge the gap when they're in the negotiation stage. And you have to plan for that years ahead rather than at the moment. So you're improving your net, after-tax outcomes, kind of without changing deal economics, which is really interesting and gives people an approach to get that done. So yeah, we're proud of some of the creative work that we've done, and that's the fun part about being a family office.
So you've just made a light bulb go on in my skull. I'm going back to the remarks made about BATNA and how that's so critical. As Jack was just saying to the group, listen, if you can enhance that, you have leverage. If we were to use these tools you're describing, we may be able to enhance the deal and make our company more
Yeah.
attractive to a potential buyer. Is that what I hear you saying, or am I reaching?
No, 100% you're correct here. You
Wow.
know, people think about, you've probably heard of key person insurance. Well, if you put a key person policy in place, that often can be used to create an asset that can be structured where the owner can maintain some percentage of it. There's an insured interest there. And when a seller and a buyer aren't quite aligned, well, here you can reach a number that can be paid now and then have this insurance policy paid out. Maybe the company's maintaining ownership of a portion of it and allows a seller to get the number they want. And now it allows them
Wow.
to hit the number they want. And oftentimes they wouldn't even know that that was an option to them. And that's been
That's
a
brilliant.
powerful tool.
That's absolutely brilliant. Um, let's talk a little bit about the big, beautiful bill. A couple of months ago, one of my colleagues, one of our friends, Kim, we did a webinar very much like this. And she talked about some of the changes that have made um, in the bill, how we spend for business growth, and how a person can take advantage of those, right, to make their business more attractive. What are you seeing in your practice along the lines of it taking advantage of the big, beautiful bill?
There is a lot going on right now. Um, a lot of it is about asset recharacterization, deciding where future value grows before it grows. Um, you can include separating operating companies from intellectual property or real estate, structuring ownership to qualify for QSBS or a qualified small business stock. That's a really attractive tool for many folks. Or you can move future appreciation into trusts or other tax advantage vehicles. So it's not about um, moving assets around after the fact. It's about positioning them correctly before they become valuable.
Absolutely. The QSBS, can you give us a little more details? Because people throw that around. I know it's like 50 million if you put it correctly that you can extract without having to pay any taxes. Is that right?
Yeah, whether it's 50 or 75, there's specific points that need to be met to qualify for that. And I can tell you a lot of investors now are have shifted away from their strategy from the last, let's say, 10 years of just buying real estate, and they're saying, I'm just going after QSBS because it presents such a powerful tool, and they see that, and it makes the difference between having a profitable investment versus not. So it's a significant piece that some of the more astute tax-focused investors are really focused on.
Wonderful. Thank you. Last question for you, my friend, my dear friend. Josh, what is it that you bring to the party? Why should one pick up the phone and call Josh and say, hey, I need to talk with him?
Well, first, I really appreciate that question. I'd like to think that we're kind of a quarterback. We have a lot of experience. We offer bespoke solutions for our clients. We spend a lot of time with them. We invest in them. And they want to invest with us, their time and their treasures, and we don't take that lightly. We work with clients who spent their entire lives, in many cases, building something, building an asset, and they want to protect that asset and they want to protect their families. And if they put the right thought into having a capital strategy lens, uh, not not just compliance, not just, profit. Um, we they're much better off in the end. We want to integrate tax planning with their investment planning, with estate planning, liquidity decisions. We think in multi-year and I'd say multi-generational timeframes. So the question isn't how we can minimize your taxes this year. It's how do we maximize your after-tax wealth over time. So, we'll
Because it's also intergenerational. I mean, you mentioned that, and I want to pounce on that as we're both fathers. And I know your children are a little bit behind mine, but I know when we speak, you're
yeah.
like, I'm setting them up. Uh, that's the lens that you have, that you bring, that sets you apart. Is that right, Josh?
Absolutely. I mean, look, we're all in this because we care about the world we live in, the families we have. We want to support them, and there are some really common sense solutions that we help bring to the table. And it's just sometimes having a creative partner, having that person that you feel you trust, that's going to work with the rest of your team. And it's not, it's not just me and my team. We're working with multiple other partners, whether it be Jack and his legal team and other advisors, and you for asset management or others. Together we help our clients achieve what they want for them and their family. So that's the most rewarding part about what I do.
Excellent. Thank you, Josh. So what we want to do now is, again, um, this is a great group of people. You've heard some of the things that they've shared. If you could spotlight back to me, please. What we're going to do is take questions. And so I think in the chat, and I've tried to pay attention to our speakers because, quite frankly, they're sharing interesting things. But by now, I'm assuming that there may be a couple of questions here. So let's go ahead and surface those and dig a little deeper. Can we have the first question, please? Do I understand that there are none? How can a business leverage trusts within transferring ownership of property? How can a business leverage trusts within transferring ownership of a property? Who would like to tackle that question, please?
Sounds like a question for a lawyer.
It's really a
No
trust and
pressure.
estate, yeah, legal question, which is a little outside of my personal expertise, but we have other attorneys at Cogent who do specialize in that type of work, and certainly be happy to consider that in a different context.
Okay, brilliant. If there are, let's see, what are the most common mistakes business owners? Okay, we had a question and then it went down. Let's just see here. What are the most common mistakes business owners make when exit planning starts too late? So we have a person who's thinking, oh my goodness, what are the most common mistakes we might make when we start late with business exit planning? And how can these be avoided? I'm going to use the word mitigated, and I'll throw the question to you, Natalie, please.
Yes, sure. One of the things that I see when things start too late is panic and not the ability of somebody to literally step back and see that they control the narrative. They can actually then decide and take the steps and take the decisions of their advisor. And that's a key point. If you try to go into exit planning without working with an advisor, that's a mistake. Unless you've been an advisor on your own or you've done it and you've been through it. But even if you've been through it, advisor is looking at things from different perspectives, different angles, things that someone that's in the middle of it will not necessarily see. And some of those biggest mistakes is when decisions are made in a panic mode or made too quickly, rather than maybe stepping back and saying, hey, we can make the right decision if we implement X, Y, and Z in a few months. Um, and also not not documenting, not doing all the things that they need to do internally, making sure that the business is running, implementing the things that are recommended to them that make sense and that are also measured. So that work is consistent, it stays with them. But I would say the number one thing that I have seen is people wait way too late, then they call, and then it's like, okay, well, my business may be worth $80 million or maybe worth $4 million, but I'm okay taking half of that, and I'll take the hit and walk away, or even think that it's not worth anything at all. So those are things to think about.
Natalie, can I add something to your comment
Sure,
there?
of course.
Uh, I, Earlier before you were saying they were testing the fire alarms, right, around you
Mhm. Yes.
when alarm
Yeah.
went
Oh,
off.
sorry about that. Yeah.
And I would just say that you were spot on with that. I think entrepreneurs should do exactly that. They should test the fire alarms, like
Hmm.
test the structures you put together, ask the
Yep.
questions, and keep digging and challenge your team to be creative. Exactly that. So I think maybe you didn't intend it, but you gave great advice when you're saying test the fire alarms.
Yeah, we kind of lived that today. I did. That was not expected of traveling, so I apologize to everyone on the
No,
webinar, but
you were giving good advice.
it
You didn't
happens.
mean it. You didn't
So,
mean it. You did.
Well, the good thing too is that when you have a team that's flexible, right, bright and able, we can
mhm,
bob and weave. Well, Natalie
absolutely.
just demonstrated that today, and so did Jack. Thank you for picking that up, Jack. So here's a question for Natalie. What are, and I'm reading this from the chat, what are the top three recommendations you give to owners that are leaving the company they built with their blood, sweat, and tears, pertaining to how they emotionally prepare for being separate from their baby?
This is a big one. This comes up more than people think. And it doesn't just come up for women. I think people also have in their minds, just as a side note, they believe that that's more for women, but I see it both in men and women. The blood, sweat, and tears, the business that you built, the identity that is wrapped up into that business. And that business is how you see yourself in your life. It takes work and time. And I think a good part of like the work that I do is also the therapy and asking the questions. You start talking about the transition out, and you start thinking about, well, if this didn't happen and I didn't have this business, what would I do? What is my other passion? And you really
You're
start getting,
batting up.
yeah, you start getting involved. You start getting really into the questions, and you want to work with somebody that'll take that question to the next level. And then as you come back with an answer, you get to the next level. And then all of a sudden, it's multi-pronged. There's so many things to consider. But the most successful as it exits also, everyone goes through this. But if you really address it, if you take the time to sit in it, literally sit in it, marinate everything, all your thoughts, all your feelings and emotions, put that towards the next thing you want to do. I've seen people start nonprofits. I've seen them go. I was on a call earlier today with somebody that's looking to buy X number of businesses. That was their next step. They sold, they exited very successfully, went, thought about it for a year or two, started a different bit, started something else on their own. Now wants to go and purchase something, but it took time, and it's okay. I also tell them that there's no wrong or right. It's what's right for you, because that's not necessarily how someone else is going to process their exit. I'm hoping
Thank
that
you very
answers the
much, Natalie.
question.
No, yeah, that's a beautiful answer. Thank you. Do any of the other panelists want to address that?
I would just speak maybe going back to some of the takeaways for business owners who are um, who have a passion for their business and want to think about how do I design this. And again, I guess I'm bringing kind of more the tax perspective here, but it's not about avoiding the taxes about for the sale. They're designing a better exit, right? It's about designing early on. And they want to leverage what they've created. And the tools we talked about here, I think, help them do that. Um, and optionality, I think, was the last piece I would say, just that as they think about letting go of the business, uh, when they can feel comfortable with what they've done, they're comfortable with the strategy, they're comfortable with the team they've chosen, the process to let it go is easier, and then they build on what comes next, to Natalie's point.
Yeah, thank you
I,
for reiterating that. Jack has a point, please.
I would simply add that an important part of any exit for an entrepreneur and part of the planning process is um, when you have a liquidity event, being comfortable that you have, the right advisor or private wealth manager to help you deploy those assets in a constructive way. Someone like yourself, Russell, and can put those assets to work for them so that they can focus on the next chapter and on things that they would like to do and have the resources properly allocated, to enable them to do that. And I think that can also be very helpful and reassuring to them.
Thank you for the plug, my friend. Uh, Having a robust asset allocation does give you peace of mind, and it also provides a magnificent platform for not only living your life, but reaching out and taking on new things that you buy, new children, if you will, adopted children. I have another question for you, Jack. This came in, and I'm reading it. From a legal perspective, what is the single most important step a business owner can take early on to reduce risk and avoid deal friction during the actual exit?
Well, early on, as part of the advanced planning process, you can make sure that um, as dull as it may sound, that the corporate housekeeping side of things are organized, things like board minutes, that reflect the appropriate history of the company, and you can you can avoid um, uh, you're falling into a trap, in a negotiation of a rep or warranty, by having things, properly structured and properly set up. But I think that, lawyers, um, uh, I think it's really a function of you're not talking just about the price, but looking at the overall economics and protecting the overall economics, from the standpoint of the transaction, the proceeds that that the seller is looking to achieve. That can involve things like focusing on working capital mechanics, indemnity caps, things that can, preparing yourselves, to have limits that when you enter into the negotiating process, you know what you're prepared to live with, in terms of post-closing risk allocation and liability, and focusing on those along the way. I'm hoping that I'm answering the question as you framed
Beautifully.
it.
Again, light bulbs are going off. Many small business owners don't think about having a robust process in place for addressing their compliance items. And when we talk, for example, you use the example of board minutes. How do we arrive at these decisions? Were they well thought through, robust
Mhm.
processes, or were they capricious, arbitrary, and potentially uh, libelous, right? These aren't things people are thinking about. They're doing whatever it is that drives income into the business. That's beautiful, Jack. And I think it just gets to what we've been attempting to pound the table on today. And that is, you want to bring experts in early, the lawyers, Jack, early, to think through, where is it that you might, because of not being able to think about that as a business owner and person driving what drives sales, that might cause value in your business to be diminished. That's huge. Thank you, Jack. There's another question here. Let's see. and we're running out of time. So we have time for maybe just one more. And this goes back to you, Josh. Uh, I heard you speak about private placement life insurance, which I love as a concept where it is needed. How does your family office feel about captive insurance? Again, going back to this concept of liability management. If you could speak to that, please, Josh.
Yeah, we know a lot about captives. We actually once at one point owned a captive insurance carrier, and I think there were some challenges with it years ago. Things have changed a little bit recently, so it's certain for the right company. It is a great solution, um, but for the PPLI, I mean, oftentimes the private placement life insurance is for you know, again, I think once that sale has happened and there's now a bolus of money that is sitting there, you want a post-exit destination for those proceeds. So if you structure PPLI properly, the gains are not subject to current income or cap gains taxes. Again, we talked about the separate managed account or the IDF, the Insurance Dedicated Fund. And in certain cases, you can create a consulting income alongside from alongside the company there, and that it can be grown within this PPLI structure. So there's a lot of exciting things that the PPLI structures can can offer. And it's bespoke, and we're happy to have that conversation with all of our clients and what works best for them.
Wonderful. If we could change the slide to the contact information for each of the folks here. Okay, so thank you for coming. We hope, I know for me, I learned a couple of new things. TikTok from Jack, the importance of PPLI, private placement life insurance, as an asset. And then, of course, from Natalie, she reiterated the whole idea of making sure you can take into consideration the emotional component. What is it you're going to do once you sell that business? This is their contact information. And as we exit, I'm going to go back to folks, and this time we'll start with the person that we had last. Is there one last point, one last nugget that you want to share before we part? Josh.
I would say don't let future appreciation occur in the most taxable structure and work with a team you trust to help you plan accordingly.
We call that asset location. Pick the most tax advantage location for your assets, particularly the ones that will appreciate a lot.
That's right.
Call Josh, he'll talk to you.
Happy to.
Go
And
now to the next
thank you for
person.
having me.
I'm sorry, Josh.
Thank you for having me on this conversation. It's really wonderful.
Always, man, always a blessing. Thank you. Jack, what would you say, sir? Your last thought.
Well, I would just say that typically, if we were going to work with a particular client, there's a process where we might schedule a no cost 30-minute call to discuss, the particular needs, the type of transaction that's being considered. And because lawyers are governed by state bar association rules, we can't give, or there are significant limits on us being able to give anything resembling legal advice on such a call, pre engagement. But we can certainly talk about some broad options. We can talk about, what the cost of the engagement might be, and various ways to approach a particular client situation. So I would encourage anyone who's interested to reach out, by email, and we'd be more than happy to schedule something like that.
Jack is a fountain of experience and expertise, and he's willing to share it. Please call him. You see his contact information on the screen. Natalie from Hawaii.
Yes. I would say to everybody that's on this call,
Mhm.
first of all, fabulous questions. Thank you for all of them because you probably saw me nodding or agreeing because I've heard a lot of them on deals. Even to the question of meeting minutes, they should be in the due diligence that your advisor is working on with you, period. That's not an excuse to not have them. If anything resonated here with any of us on this call, by all means, reach out. I saw some really good questions come in, even about talking either about experience, about what to expect, but don't remember that either if you're advising or if you're part of the team, some type of a planner, estate planner, tax, whatever it may be, start thinking about things early. Remember that exiting is an option. It's not something you want to make a decision on last minute. You want to have your options from the beginning. So my name and number is there. I would offer to anybody to reach out, please. Thank you. And this was a lot of fun. Thank you, Russell.
We're going to do it again. Friends, all the best in keeping with our promise to be timely. We started on time, we'll end on time. Thanks for coming, and reach out to us if you have questions. All the best.